S, Chairman, THRISSUR Chapter of ICSI. Engineer Vinod Manila, President of THRISSUR Management Association. CMA Praveen Kumar, Chairman of THRISSUR Chapter ICAI CMA, who is joining us online. Chief guest of the event, Shri ARUN EA, Assistant General Manager SEBI, who is joining us online. Faculties for the program, CS Jackson David and Shri ABHIN R. NAIK. I now request CA Ajit Kaimal, Chairman of SIRC of ICAI, for the welcome address.
Honorable Chief Guest, Mr. ARUN EA, Assistant General Manager, SEBI, faculties of today's program, CS Jackson David and Mr. ABHIN R. NAIK, Engineer Vinod Manila, President TME, CMA Praveen Kumar, Chairman ICA Chapter CMA, I think he will be online, CS Sugesh Ram, Chairman ICSI, members of the different financial and management professions assembled over here, students and everyone. Good evening, dear all. I must mention that it has been a while that THRISSUR's premier organizations came together for a joint program. In fact, I remember it correctly, it was before COVID that we had a joint program. And I am using this opportunity to emphasize the need of more and more programs for the general benefit of THRISSUR's. Now, today we are assembled here for a joint program on investor awareness. And now let me move with my job of welcoming all. The chief guest of today's program, he has joined online. Mr. ARUN EA is the sole representative of SEBI in Kerala. The market regulator has always made meaningful strides in both policies and investigations. On behalf of all the organizations assembled over here, I do welcome Mr. ARUN EA, Assistant General Manager SEBI, Kochi, to the program.
Thank you.
Now, our faculties of today's program, the first session, Uncertainty, Friend or Foe for Investors, is being taken by CS Jackson David. He is one of the first certified financial planners to qualify from Kerala and is a very prolific speaker across Kerala. Now, on behalf of the organizations gathered over here, I do welcome CS Jackson David to this program. Now, our speaker for the second session initially scheduled was Mr. Joji Abraham David, Deputy Vice President of Kerala, but he couldn't make it to today's program because of pressing unavoidable issues. And he has deputed an equally qualified, capable person to take the session. On behalf of the organizations assembled over here, I do welcome Mr. ABHIN R. NAIK, Assistant Vice President, SEBI SBI Funds Management Private Limited, to this program. The joint organizers of today's program, I do welcome Engineer Vinod Manila, the president of one of the best management associations in South India, and TMA to this program. I also welcome the chairman of our sister institutes, CMA Praveen Kumar, Chairman ICAI Chapter CMA, and CS Sugesh Ram, Chairman ICSI, to this program. Now, I also welcome all the members of ICAI THRISSUR, ICSI THRISSUR, ICAI Chapter CMA, THRISSUR, and TMA gathered over here for this program, and I also welcome the students who had assembled over here. Thank you.
Thank you, sir. and now take the responsibility to introduce the chief guest for today's event, SHRI ARUN EA. SHRI ARUN is currently working as Assistant General Manager with SEBI, Kochi local office. He has more than 10 years experience in SEBI and has worked in Corporation Finance Department, Market Intermediaries, Regulation and Supervision Department, and Office of Whole-Time Member, SEBI, before getting posted at Kochi local office. During his tenure in SEBI, he has handled matters pertaining to IPOs, schemes of arrangements, listing agreements, compliances, and related enforcement actions. He has also worked with Indian Audit and Accounts Department before joining SEBI and has around 7 years experience in conducting performance audit, compliance audit, and accounts audit of various central public sector enterprises. SHRI ARUN is a company secretary and a commerce graduate. We welcome you once again, sir.
Thank you. Good afternoon, everyone. I hope I am audible. Hello. Hello. Am I audible?
Yes, sir, you're audible.
Okay, thank you. So good afternoon, everyone. And thank you very much for the introduction and as well as for the opportunity. So first of all, let me congratulate the ICAI, ICSI and ICAI CMA chapters and THRISSUR Management Association for coming out with such a wonderful investor awareness initiative in THRISSUR. And incidentally, this is coincided with the Global Money Week celebrations that we are celebrating this week. Because this week, starting 21st, is being celebrated globally as the Global Money Week. And this has been celebrated under the aegis of OECD. And SEBI is the national coordinator for Global Money Week. So, coming to our program, so investor education is of very vital importance in our day-to-day lives. An educated investor is considered as an empowered investor and a protected investor. So, SEBI follows a disclosure-based regulatory approach to regulation of securities market. So, in that disclosure-based regulatory approach, information or disclosure is the backbone. So, that constitutes the importance of investor education because only an informed investor can successfully invest in stock markets. Because unlike the controller of capital issues regime, SEBI follows a disclosure-based regime where SEBI mandates entities to disclose whatever price-sensitive information available, which is required for informed decision-making to the stock market, and the market participants, including investors, will take a call based on the information that is available. So, an investor should know what information to look for, where to look for, etc., to successfully benefit from investing in stock market. So in my tenure with SEBI, especially during my tenure in the Kochi local office, I have come across various instances where investors have been cheated by various scams and schemes. So the most important aspect that is coming out from this experience is that in many of the cases, the investors who have been cheated were otherwise highly educated investors who are well placed in the society. So that brings forth some other aspect of it, that all educated individuals are not educated investors, because investor education is totally different from the normal education that we generally refer to. And financial literacy and investor awareness are totally a different skill set that has to be separately acquired from various workshops or various investment education seminars or through other deep reading and understanding of the subject. So it doesn't come automatically to us, it has to be separately acquired. So in that instance, this investment awareness programs are of vital importance. An investor should be aware of his investment purpose for which he is investing, the period for which he is investing, and also the risk appetite that he is able to take. before deciding on the right kind of investment. Of course, stock markets always provides a wonderful venue for investment. Census has given us around a CAGR return of 15% since inception. So that brings forth a wonderful investment opportunity for long-term investment. That long-term investment is of vital importance because in short term, the stock markets behave rather differently, and it doesn't follow a logic while behaving in short term. Because the most important example is the behavior of stock market during our COVID-19 lockdown. During the first phases, when the entire country was under lockdown, throwing all the economic indicators downward, stock market responded in a totally different manner, and the stock market has gone almost 100% upwards. The BSE census was around 25,000 points in the month of March 2020 when we went for lockdown, when the initial lockdown was set in motion. From there, the census rallied up to the 50,000 points within a span of 10 months, giving a 100% return to investors. When all the economic indicators were going downwards, the census gave investors a 100% return. So that brings forth the unpredictable nature of stock market during the short term. So that calls for the need for investor education separately, because it doesn't follow a common logic. Even though economy is going up, even though all the companies are doing well, stock market in the short term may not give you the return as expected, and vice versa. So stock market ideally is not for starting investors. Stock market is not the ideal place for placing their short-term funds. So since nobody can predict how stock markets would behave in the short run, an investor should know the intricacies of the stock market, the inherent risk involved in the stock market, and the various investment avenues available in the stock market before deciding on the right course of investment. Because stock market, even though we call stock market as the Ohari Vipani in Malayalam, it is not just about the Ohari or the equity shares. Stock market has equally vibrant what they call bond market. It also has equally vibrant derivative market. And there are also various other interesting products like real estate investment trust units, infrastructure investment trust units, mutual funds, exchange traded funds, etc. So we should know various avenues available in the stock market before deciding on the right mode of investment. SEBI has been taking various investment awareness programs across the India in association with various institutes, various associations, etc. Apart from this, SEBI has also taken various steps to make stock market a more investor-friendly destination. So I would like to discuss a few steps taken by SEBI in the recent past to make securities market a more investor-friendly place. So first, SEBI has come out in the recent period. SEBI has come out with a what you call margin pledging framework in association with the depositories. So this margin pledging framework has enabled investors to provide their securities for margin without having to transfer such securities to the broker's account. So this has arrested the possibility of misuse of securities at the broker level. This is one of the major steps that we have taken to prevent the frauds like Carvey scams that we have experienced in the recent past. SEBI has also enabled online KYC, electronic KYC for clients to do KYC sitting at the comfort of their homes without having to visit the offices of the stock market intermediaries. So if a person has to open an account and do KYC, he can do the KYC sitting at home using the Aadhaar and DigiLocker framework. Again, SEBI has also come out with clarifications on the power of attorney. Power of attorney has been one of the most abused aspect of stock market, where trading members have been known to abuse this facility provided to the investors. Because currently, with depositories providing online transfer facility and online debit facility from your demat account, this requirement for power of attorney is no longer in existence. So we should think twice before signing the power of attorney and giving it to your broker, because power of attorney is as dangerous as a blank check. And it is no longer required. It is required, maybe required for a few individuals, but not on a normal level. It is not required. So we should be aware that power of attorney, but many of the investors, I would say most of the investors who are trading in stock market, either knowingly or unknowingly has given power of attorney to their trading members. So be aware that it is not a mandatory document and give it only if required, because it has its own inherent risk. And SEBI has also enforced the margin requirements on a stricter framework during this recent past. That has been done to address the extreme volatility that is observed in the market during the COVID lockdown. That has also helped preserve the integrity of the market. So I am not taking much of your time now. We have 2 more sessions on the stock market and mutual funds coming up. So I would like to express my gratitude for providing this opportunity and not taking further time. So thank you very much for the opportunity. Thank you for the patient listening. Thank you.
Thank you, sir, for your insightful address. Now we shall move on to the first session of the event. But before that, I request CA Manoj Kumar to introduce our speaker, CS Jackson David.
Good evening. Our speaker today, Mr. Jackson David C. FCS CFP, is a fellow member of the Institute of Company Secretaries of India, is the past chairman of THRISSUR chapter of Institute of Company Secretaries of India, one of the first certified financial planners under Financial Planning Standards Board USA to qualify from Kerala. He is a member of Association of Mutual Funds of India, registered mutual fund distributor, founder partner of Navion Wealth, one of the leading firms in the state distributing mutual funds, portfolio management service, and alternate investment fund. Also involved in angel funding syndication in the startup space. Does corporate training in specialized areas related to wealth management. Served as guest faculty in several management and finance schools. Engaged as a consultant on strategic business management and financial analysis. He is the founder partner of consulting firm Navion Consultants LLP. He is the presenter of the YouTube channel for financial education, Navion Wealth. With this brief introduction, let me introduce to you today's speaker of the session, Mr. Jackson David. Thank you.
Thank you, CA Manoj. I now request CS Jackson David to please begin his session.
Warm good evening to all of you. We have a lot of dignitaries here. I salute to all of them. Chairman of C Institute, C. Ajit, Secretary, Mr. Sadish, C.S. Sadish. Chairman of CS Institute, C.S. Sugesh Ram. beloved TMA President Engineer Vinod Manila, dynamic Secretary of TMA Mr. Francis George, and in their absence, the Chairman of CMA Chapter, CMA Praveen, Chief Guest of the Day, Mr. ARUN. It is a very august occasion, and I am thankful to the organizers, all the organizers, for giving me the opportunity. Most of the participants are students, so let me address a question to all of you. Is it a good time to invest? How is the economy doing? Good or bad? What is going to happen to the economy in the next 3 months? Is it good or bad? Just keep that in your mind. I can't hear your responses anyway. But it is a thought you have to keep in your mind. So these are uncertain times. If you ask me to number the problems, I can have a long list of problems that are facing us. Either be the business, either you're a businessman or an employee or an investor, you can see a lot of problems, plenty of problems actually. The war is a very big sword above our heads, and inflation is there, it is running away, inflation is running away, and interest rates are about to rise. It has already started to rise. Lot of problems, availability, supply chain issues, international shipping problems. If you look at economies across the world today, it is one of the worst time, or maybe very, very difficult times for most corporates, most people. But is it something new? Is it something unique to the markets, unique to the economy? These are uncertain times, but these are the only uncertain times we have faced. And these will not be the last of the uncertain times we are going to face. So whether as an investor, today's topic and session is focused on the viewpoint of the investor, mostly somebody who is investing in financial products or maybe investment avenues. For somebody like that, whether uncertainty like these times, it is a friend or a foe, friend or an enemy, that is a question we are going to ponder in the next half an hour. Most of you are good in numbers, I know that. You don't have to talk about all the 3 institutes. TMA, of course, they are good in numbers because being an efficient professional managers, you have to be good in numbers. But this is what Peter Lynch, one of the most famous investors, what he had to say. It is more of an art. It is a science. I don't fully subscribe to his view that it is fully an art. Even he hasn't meant that. But it has an art element into that. So you can't put everything into numbers. Most of us in this hall today, we are good in numbers and we tend to think everything, quantify everything. So in the case of investments, it is not the most wise thing to do. That is what he said, Peter Lynch. So my presentation, my focus is more on the non-financial part, or maybe the what cannot be quantified, that kind of a part, the emotional part. How you can handle the uncertainty, the difficult situations, so that as an investor, you can be the winner in the longer run. Long run means not too long. As John Maynard Keynes said, in the long run, we are all dead. So not just that, even if you think about 5 years, 10 years kind of time frame, as investors, uncertainty could be your friend. And we can see various aspects of that. This is the person on the left side. Anybody can identify him? I hope it is visible, the name. That is the guy who said the quote in the previous slide. His name is Peter Lynch. He ran the Magellan Fund. It was owned by Fidelity. He ran it for 13 years very successfully. His CAGR was something like 29%, mostly investing in US markets. So 29% is very good. So this is the guy who subscribed to this view that numbers are not good. There is other guy on the right side. And that is a totally different viewpoint. He is the guy who only ran numbers. Anybody recognize him? Let me ask you a question. Who is the best investor? The biggest investor who had made the best return in the last half a century. Most of you will be thinking about Warren Buffett, isn't it? or maybe his partner Charlie Munger. But this is a guy who made all these gains. The gains of his fund is something like 66% over a 40-year period. You can't invest in that fund. It is so exclusive. Nobody is allowed to invest anymore into that fund. The fund name is Medallion Fund, and the company is called Renaissance Tech. So that is another totally different viewpoint. I just wanted to share these two viewpoints. And the second viewpoint is also valid, but they run algos. They don't do it manually. They don't run the numbers manually. He is the guy who actually invented the algo trading kind of thing, algo investing kind of thing. So that is a different aspect altogether. But most people who are investing personally in personal finance, you don't have to think too much about those kind of numbers. And you're competing today with the algos. So you can't beat the algos very easily. Unless you have an algo, good system for yourself, you can't beat these kind of guys. So better stick to the emotional part, better stick to the balance part, and take decisions more on the art side of investing. That is what most investors will be well off doing. This is a difficult times, and difficult times bring out these kind of emotions. This is a real quote. When I saw this quote, I thought maybe Einstein may not have said something like this. We get WhatsApp forwards of all kinds of quotes which are fake. But this is a real quote. I cross-checked that. This is a real quote. And I found it very interesting in the investment viewpoint also. These are three great forces that rule the world: stupidity, fear, and greed. Stupidity, we'll talk about that later. Let us first talk about fear and greed. One more question to think of. You need not answer for that. Which is the biggest force, fear or greed? Greed or fear, which is the biggest force? Maybe you can answer also. Greed? It is a very subjective thing. You can't have a solid answer for that. I am of the school of thought that thinks that maybe fear is the bigger emotion. Even in the greed kind of thing, there is a fear part. That is what we investors call something called FOMO, fear of missing out. Most people invest into the markets at the highs, invest into stocks at their highs, invest into crypto at their highs because of the fear of missing out. That is called FOMO. So that again is fear playing in your minds, which is masquerading as greed. Maybe it is more of a fear kind of thing. So all these issues, even greed is not good, especially if you are thinking in the short term. Long-term greed is good actually. You have to be greedy in the long term. If you want to make money in the markets, you have to be greedy in the long term and maybe careful in the shorter run. That is what the science says. Now we come to stupidity. This is something that happened yesterday. These two tweets actually happened yesterday. There is a stock called Syntex Industries Limited. We all know the company Syntex. The company is very good in making plastic tanks and all these kind of things, but it has gone bad. It has gone into bankruptcy, and actually yesterday the insolvency resolution was approved. And I am sure that people in this hall understand that once the resolution is approved, there is no much way ahead for the company, especially in this particular case, because the equity was fully written off. The equity was completely written off and it was taken over by Reliance Industries. And still the stock was trading at 7.80 rupees yesterday. The Zerodha, despite being the market leader, this is a company that I admire because they don't try to increase their volumes at the cost of their investors. Actually, they have a system called nudge, in which when you start to trade, the system will alert you if you are going to make a stupid move. And yesterday they had a nudge that is going on. That is in a small box above the trading window screenshot that I've given. The nudge says that don't buy this stock because it is going to be zero for sure. There is no uncertainty actually. It is going to be zero for sure. And still 50 lakh shares were traded yesterday. I'm not talking about 20 years back. This is yesterday. In the age of information technology, all the information pouring in, and we are actually crying about too much information these days. And this is what happened yesterday. So this is stupidity and this is greed. And this is fear that I am missing out on something that is not known to the markets. People are thinking that there could be something in the markets because so many people are buying the stock. So simply people are going in herds. That is what is called the herd mentality. So even in certain times or uncertain times, people typically take the herd mentality And you take decisions looking at others, what others are doing. So this is what the CEO actually tweeted yesterday. Few customers are still buying Syntex. It will definitely go to zero, and they have something called TOTP, in which again that is a kind of a manual block they have put in to reduce the number of shares that are being traded. So why are people making this kind of mistakes? What causes these kind of mistakes? This is a different kind of mistake that is totally different. The mistake that happened in the case of Syntex is kind of different. This is what normally happens. Every market highs, every rally, you can have people who are coming in the last stage. Whenever you look at the markets, you can see that the market has kind of topped out. When even the market, that is saying that when the person who polishes your shoe, it is a saying in the West, he is talking about stocks. In our context, it could be our maid or maybe a person who is assisting us in the office or something like that. Everybody is talking about stocks. It is a dangerous time to invest. And when the markets are down, people sell out. People run away from the markets. This is what normally happens in the markets. But now on this count, I can see a huge difference, especially in the last 2 years. Even in the COVID crisis, we had a lot of people who were actually buying. It's a good thing actually, because people had a lot of inputs. That is a good part of having information flow in this age. People were having a lot of inputs from the from the Twitter or maybe the all the social media. There were knowledgeable people who are guiding investors. So that is one part. But second part is that there are a lot of misinformation or maybe bad advice going on. So you have to be careful about both these aspects that are available. Whenever there is a fall in the market, there are actually people who come up and say that this is what I actually said. Those who are observing the markets for a long time maybe know a guy called Mark Faber. Boom, Bloom and Doom is the name of his website. He's a guy who always is very bearish about the markets. So whenever uncertainty comes, when the war happens, COVID happens, this kind of guys come into the TV, and the TV guys is actually invite these kind of guys at that times, and they'll say that, look, the market has gone down. Everything is bad right now, and this is what I have been saying for the last 10 years. So this is a kind of bad advice you can get during difficult times. Uncertainty is part of the markets. Uncertainty is part of investing, and you have to expect difficult times whenever you're investing. You're investing for 5 years, 10 years, 15 years kind of thing. Especially if you're an equity investor, if you are a mutual fund investor, even if you're a businessman, you are not investing for 1 or 2 years. You're investing for decades actually. So any kind of investment, you have to have the long-term vision, and you have to understand that the economy, the markets will go through difficult times. There is no point in having your entire portfolio designed to only for the difficult times. There are people who invest only in fixed income. There are people who only invest in something like a safe haven asset like gold. There are people who are called gold bulls. They invest only in gold. I, as a personal finance person, always say that gold should be part of the portfolio. There are different views on that, but you can't have your entire investment in gold. You can't have your entire investment in fixed income or maybe something as safe as government bonds, because ultimately you will lose on what is the biggest risk for any investor, which is inflation. What is inflation right now? Maybe the students can answer on that. What is CPI inflation right now? It is quite high, isn't it? 7.9 in the US actually. We are used to those kind of figures, but those guys are never used to those kind of figures. Right now, the CPI inflation is higher in the US than India. So that is a very big risk for any investor. You have to beat the inflation for your money value to retain, for your investment to retain its value. You have to retain the value of your investment, and you have to beat inflation. That is a minimum target for any investor. So you can't be over cautious in the investment arena. You can't think that, okay, the times are going to be bad and I'll invest only according to that. You always have to have something that we call asset allocation, that is investing in different asset classes. Diversify. That is the answer for all these problems and issues of uncertainty that is facing investors. This is the journey of Sensex from the beginning till now. If you have watched Sensex from that time to now, you will be very good. Somehow I observe that most of the people who are good in investments, they have maybe white hairs. You see those two guys I showed in the earlier slide, Jim Simons and Peter Lynch, they have white hairs. I don't think that is a coincidence. And maybe they are bald also like me. I have both, white hairs and bald head. It is my strategy of showing off that I have watched the market for a long time, despite me being not that old. So this is what Sensex went through all these years. So when you see the history of Sensex, it was not a one-way ride up. If you see the history of markets, stock markets, even economy, any big corporates, it was never a one-way ride. There always could be problems. There always will be problems. It is only that we don't know what is going to happen. Just before the war happened, most of our clients will ask us, the markets are very high, the economy is fighting in boom, could something go wrong? What is going to go wrong? And the only answer I have all the time is that I don't know what is going to go wrong, but I am sure that something is going to go wrong, at least in the future, in a reasonable span of time. Because once it has gone up, it will find some reasons to go down. That is how the market behaves. That is how the economy behaves. It always moves in cycles. It is never like this. It always moves in cycles. And the cycles is not like this. Luckily, we don't have cycles like this in the markets, except maybe for the exception of the unlucky country called Japan. They are having a bear market for the last 40 years. Pray to God, hope that we don't have these kind of cycles. We have these kind of cycles. So whenever there is uncertainty, whenever there is a risk going on in the market, difficult times going in the market, something will come up positively, something will boost the economy, and it will go up. And once it goes up for a particular period of time, it has gone up, the valuations have gone up beyond comfort levels, the market will find some reason. This time it was war. I'm not saying that war is a good thing or maybe something very not very serious. Of course, it is a humanitarian crisis. It is a very difficult situation for people who are involved. It is a very difficult situation for people who are trying to manage affairs, whether be in corporates, in the corporate world, whether be in geopolitical situations. It is an unfair situation. It is an unpleasant situation. But it is an unavoidable situation. Somewhere or other, these kind of things happen. We are under the impression that the times have changed and we won't have a war. Even in our community, most people thought that the war will not happen because nobody can afford a war. That is a term that we often hear. Even today, most people believe that we are going to have a compromise, including myself. I believe that we are going to have a compromise between the two countries or maybe the two forces because nobody can afford it to go on forever. But I may be wrong on that count also. We have to be prepared for even that also, because we have had wars which have lasted for decades earlier. Again, I hope that it won't last that long, but you have to be prepared for that as an investor. You have to be careful about that. You have to look at the situation in a balanced and measured way. You can't go to the two extremes of thinking that it is nothing, it will pass in a month or two, or maybe the other extreme that it is going to be doomed forever. These are two extremes. You don't have to go to the two extremes as such. There is a saying that there is a kid inside everybody. This is more true actually. There is a caveman or maybe a cave woman, a cave person, an ancient person inside every one of us. A person who was living in the forest, a hunter-gatherer, who was fighting animals, fighting the forces of nature to survive. So whenever there is a risky situation, whenever a person like this that you are seeing in the screen, whenever he was facing an elephant or maybe a wild animal or maybe a enemy, there are two options available. That is called the flight or fight response. Even today, we have the same kind of response that is hardwired into our brain. Whenever we face an uncertainty, these are the two kind of approaches people take. In the stock market or maybe the investment arena, normally people take the flight mode. People typically tend to run back. Whenever there is a problem, the people typically tend to run back. Now, since youngsters are investing, youngsters are trading across the world, not just in Kerala, not just in India, I believe that many of you are trading at least in a small way. If not, you should try being students. I think I'll request you to try it in a very small way. So maybe because of that, we have the other response also. There are people who fight, people who take on the bull by the horns. That again is not a wise thing to do in the stock market or maybe investment assets. Because you have to be very careful about what is going to happen in the future. You can't be sure about anything. Anything you cannot be sure about. When is war going to end? Nobody in the world is going to have a solid answer for that. Least of all, Mr. Putin. So it is how events are going to unfold in a way that we cannot foresee, we cannot predict. We can be prepared, that is all. We can't predict the future, we can't foresee the future, but we can be prepared for that. That is all we can do. So either of these responses may not be wise, may not be advisable. You have to take a middle path, like most things in life. In most things in life, you have to take a middle path. In anything you take, you can't go to one extreme or you can't go to the other extreme. So you have to take a middle path. Actually, there is a third option available for animals. But from what I understand, it is not available for humans. That is a freeze. Flight, fight or freeze. There are a lot of animals that actually play dead when they are faced with a crisis. It does not come naturally to humans. That is what I understand. It could be a good strategy in many cases. You don't have to do anything. If you are an investor in the stock market and you have a good portfolio, in many cases, you don't have to do anything at all. Unless do some rebalancing in your asset allocation. That may be warranted if the market has moved by a lot. But you have to be careful about the biases, the heuristic biases, the mistakes that you are likely to make when you are facing a crisis situation. When you are facing difficult times, uncertain times, you are likely to make mistakes. That is called heuristics. Behavioral mistakes. Behavioral biases we have. The science is called behavioral finance and behavioral economics. If you are not interested in behavioral finance, I suggest that you read something on that. And the guy who, the people who actually came up with this, the details of this theory, they are called Daniel Kahneman and Amos Tversky. They have a fine book called Thinking Fast and Slow. If you are interested in reading, I'll suggest that that is one book you have to read. It is not an easy read. It is said to be one of the very difficult and boring reads, but I'll say that it is worth the effort. For anyone, not just investors, anyone, it is a very interesting book. Thinking Fast and Slow. So there is something called anchoring bias. It is a very interesting heuristic bias. The example in the picture shows, actually, they had a different example for their experiment. In this, they're asked to think of a 2-digit number. Two guys, the green guy and the blue guy, they are coming up with two numbers. The green guy say a random number 11, and the blue guy says a random number 99. Just what came into their minds. I think the actual experiment asked them to quote the last 2 digits of their social security number in the US. Maybe something like our Aadhaar number. It was the original experiment. And they were asked to value something. In this example, it is a wine. They are asked to value something based on their judgment, not the number they just quoted. The number is a very random number. It is not related. The first question is not at all related to the second question. But here is the caveman or cavewoman comes into play, and we have something called this anchoring bias. This number actually plays in our mind without we actually knowing it. When we read about all these experiments, we find it funny that most of these experiments are actually conducted on MIT students. The smartest set of people you can find on the planet, or maybe among the smartest set of people. So this is not about being intelligent. This is not about being smart. This is our ancient person inside us actually taking over during difficult times. So this is called anchoring bias. A lot of people have anchoring bias in the case of stocks, in the case of markets, investment. So we have seen Sensex going up to 62,000 or Nifty going up to 17,000 odd. And we have that figure, that number that is playing in our minds. When market comes down, we feel that, especially youngsters have to take care of that. Most of them feel that it is going to go back into that same number very quickly. It may or may not happen. It happened during COVID. It actually went up very fast. Fastest than most big falls we had in the last century, I believe. It was the fastest recovery we ever had. It was the fastest fall and it was the fastest recovery, but it may not be the case every time. It may happen this time also, but nobody can guarantee that it is going to happen again. So this 62,000 Sensex kind of thing should not play in your mind too much. You should not give too much weightage to that. Some people actually have their anchorage on the lowest number also. The Sensex went down to 26,000 during the COVID crisis, March 23rd, 2020, exact. That was the exact date. So many people have their anchors on 26,000. So when the Sensex started moving up, the market started moving up, they were kind of saying that it is now overvalued because it went down to 26,000. Today it is overvalued at 40,000. And you know what happened later on. A lot of people were staying in the sidelines. They had their FOMO that I mentioned earlier only when Sensex started crossing 50 and 55,000. Then they started to invest again. They lost the opportunity. So you can't go to the either of the extremes. You can't anchor your expectations or numbers on the lower number. You can't keep it on the higher number. Even in the case of stocks, this anchoring could be an issue. This is the Paytm company. The company is not called Paytm. The brand is well known. That is why I mentioned that in the slide. The company is called 197. So this is what happened in Paytm stock in the last few months. The IPO price was something like 2,150, and yesterday it was trading at 565. What is the value of Paytm? I'm glad to say that I am honest enough to say that I don't have any idea at all. And I am sure that even Ashwath Damodaran, who is the best guy across the world in valuation, equity valuation, he has also said that honestly, I don't know what is the value of Paytm. Who can value Paytm? I don't think anybody can value it. So, but we have an anchor in our mind saying that IPO price. It has come down from the IPO price by this much, so it should be a bargain. I'm not saying that it is whether it is a bargain or not. Actually, frankly, I don't know. But I'm saying that you can't keep the IPO price as your benchmark. Even Zomato is something like half of what it traded on the first day after IPO. So you can't think that it is a big bargain. The biggest mistake people do when market falls or maybe uncertain times come is that they typically buy these junk stocks. If my clients want to invest, we don't run a trading firm. We only actually service or do only in the case of mutual funds, PMS and AIF. But many of our clients actually ask us what to invest or maybe what is the stocks to invest in. I have one simple advice to them. Don't go for the junk stock kind of thing. If you're investing, only invest in quality companies, do your numbers, do your study and invest only in quality companies, because you don't know when it is going to stop. There is a very favorite phrase of people who are anchoring on CNBC. They say catching a falling knife. So it happens all the time. So you can't have an anchor on that. And suppose today Paytm is, I think the stock is again 20 rupees down. Suppose it goes down to 400. Then again a new anchor come to your mind, 400. Then it goes up to again say 600, people won't buy. Maybe the fundamentals have changed by them. I'm hoping that they get their act together. There are companies, those who have actually changed their entire business model. One example is Bajaj Finance. Even I was very apprehensive about the stock in the 2005 to 10 kind of period. Somebody in our discussion was talking about Bajaj Finance having a very bad phase during those days. But Bajaj Finance as a company has completely remodeled their business. They have become a personal finance and consumer finance kind of monopoly in the market in the next 10 years. So you can't have an anchor saying that Bajaj Finance was trading at maybe 50 rupees at that time. I won't pay 200 rupees for that. So both these anchoring errors, don't make that. Herding errors, don't make that. Herd mentality, that is what I mentioned earlier also. Everybody is doing something, let me also do that. That is the herding mentality. Sunk cost fallacy. That is again one I haven't kept in my slide. That again is a very interesting behavioral bias people have. Sunk cost fallacy. Even business persons have that. Senior business persons will vouch for that. And that is one attribute they have to fight with their own employees most of the time. You have invested, you have started something, and you want to change course midway. Nobody will allow to do that. We have already invested. Normal thinking. Already we have invested this much. I have invested in a particular stock or maybe a mutual fund. and now the NAV is down, the price is down by maybe 20%, 30%. Ipo change illa. Karanam ini adu tirichu keri pazhaya level avate. That is what people often say. Tirichu ente purchase price I am willing to sell. But aduvare njan sell illa. What happens is that you get beautiful opportunities to rebalance your portfolio, change your investments. You don't do that, thinking that my purchase price is still away. So that is called the sunk cost fallacy. Already you have spent this much on this, so I can't take the loss. Loss aversion. That is again a big subject. I am not going into that. So what is the solution to all these problems? I am not saying that it's a very simple solution. Investing is simple but not easy. That is the key word to remember. Investing is simple but not easy. Not easy not because of the numbers or difficulty in computing or something like that, because of the emotions. Again, the cave person inside you could be your enemy. So one solution, simple solution for most people is that asset allocation. Follow asset allocation. It is applicable for any kind of investors. I'll say that even for business houses, asset allocation is important. We have a lot of people who are investing into startups and different kind of investment apart from their own. I think just like in the case of philanthropy, Mr. Asim Premji was somebody who started that kind of a thing. He had his own family office back in the 90s itself. And he started investing in other ventures. They had their own startups. He started investing in other startups. Even Nandan Nilekani, Narayanamurthy himself, they are all big successful investors in startup space these days. Yesterday I was reading about Fundamentum, the startup initiative by Nandan Nilekani. They have very successful two investments. One is Spinny, there are car dealership, and second one is Pharmacy, which is a online pharmacy company. So that is diversification. The beauty of diversification, having not all your eggs in a single basket. Let us forget businessmen for a moment. And for personal investment, it is all the more important. You have to have different kind of asset classes. You have to distribute it across all the asset classes. As I said, my firm does mutual funds, but I am one person who says that you can't invest all your money in mutual funds. That is one refrain I have to remind my clients even most of the time. You have to have a balanced asset allocation. You have to have real estate, but you don't have to tell that to people in Kerala or India. Most of them have 90-95% of their investment already in real estate, especially if you're wealthy and in Kerala. In most cases, you have 90% plus investment already in real estate. So that is something we don't have to remind them. Even in the case of gold, people are over-invested into gold in most cases. But equity and debt investments, people are not that, especially financial investments. People traditionally not used to those kind of investments. The only financial investments that they used to do was fixed deposit or maybe insurance kind of money back plans and LIC kind of insurance. Those are in the nature of fixed income products. Equity, typically people are underinvested. Some people do trading and mistake that for investment. So again, that is one mistake to avoid. Do equity investment. I'll suggest that you do mutual fund. Don't through me or my firm. You find a good index fund to invest. It is a very simple way to invest. A lot of good index funds are available today. It is very, very hard to beat an index. Accept the fact. Even if you are a financial expert, even if you are a financial student, whatever be your background, however time you invest on that. People often say that I don't have the time to invest. I'll say that if you have more time, you will make more mistakes. It is not that easy to do, even if it is simple. So go through a mutual fund route, go to the index fund route, go to the ETF, exchange traded funds route, or maybe active mutual funds. If you have an idea about what mutual funds are and what kind of fund managers are there, or you have a person to advise, you can take the active mutual fund route. But you have to have your equity investments. You have to have your fixed income investments also, debt mutual funds, or maybe fixed deposits, post office deposits, treasury deposits. All these avenues are available. So you have to have a balanced asset allocation. At least 50% should be in financial asset. That is what we often say. 50% you can have in physical asset. Physical asset means real estate and gold in most cases. And you have a lot of options also available. Real estate, earlier it used to be only physical form. Today you have something called REITs are available. REIT, real estate investment trusts are available, which are working beautifully, at least in some cases. You have international REIT mutual fund available today. Mutual funds that are investing into international rates, even that kind of a product is available. Right now, there is a technical issue in that, but maybe it will open up again. And you have portfolio PMS and AIF investing in real estate. All those avenues are available. Equity, again, shares is a obvious option, but I'll say that is not the best option. You can do trading, as I said earlier, for learning things, or maybe for the heck of it, for the thrill of it. But your core portfolio should be about index and mutual funds. That is ideal way for most investors. Debt or FD could be in the nature of deposits and debt mutual funds. I'll say that debt mutual funds make sense only for a limited set of people right now. Returns are not that attractive. And gold, again, you have different options like coins and bars. That is a traditional option, physical gold. Now today you have the mutual fund route also, and sovereign gold bond by government, issued by the central government. That is a very good option if you have a 8-year plus kind of time frame. So these are the asset allocation options available. Have a balanced portfolio. The percentage of allocation you can decide on your own. You have to do the risk profiling. I'll say that even if you allocate equally between all these 4 asset classes, that is a very simple solution, but it still works. Or you can have a 50% allocation to real estate. Most of you don't hold, youngsters may not be holding land, but you will be holding later on your family property, or you may be getting something like that, or you may be buying your own house. So don't over invest into real estate. That is the refrain we have to often repeat. And you have to have a financial allocation, at least 50%. Part of that should go into fixed income in the form of any kind of deposits or maybe debt mutual funds. And equity, again, is very important. Equity, most people say it is a dangerous thing. I'll say that there are short-term risks. There are long-term risks also. But once you understand the risks and have a balanced kind of allocation into smart ways of investing, like the case of index funds or mutual funds, those are smart ways of investing into equity. If you are that much interested in stock analysis, then you have to do the numbers that I said earlier to ignore. You can't do stock investing without doing the numbers. You have to go through the numbers. You have to understand PE, you have to understand PBG, you have to understand price to book, you have to understand dividend yield gap, everything you have to go through that, even discounted cash flow, everything you have to do, and you can do your own, but be very careful in that. Just one small thing to end. That is a lot of people, when I mentioned discounted cash flow, that is what came into my mind. There is a saying that discounted DCF is like Hubble telescope. You move it an inch and you are actually watching a different galaxy. DCF is like that. You change numbers, 1 or 2 numbers, you get totally different numbers, totally different results. So be very careful in using on all that. For the given time, we don't have to go into the details of that. Even otherwise, I'll say it is boring. It is boring to go through the numbers, a kind of thing, the technical kind of thing in a session like this. Lot of material is available online. Lot of material advice is available online. Only thing is that curation is very important. Curation is a very underrated thing these days. You can't read everything. You can't follow everyone. You can't follow all the WhatsApp tips that you get, all the tips on Twitter that you get. That is a very dangerous thing today. Thing to do. You have to curate what you are actually consuming. People who are good in curation. Twitter is a very good space where there are very good curators available who are actually guiding investors in a very good way across the world. So you have to find people like that and follow them. They will give you the right kind of advice, or maybe curate the right kind of articles to follow and take the right kind of decisions. So that is from my part. Hope that I have given some thought for the day. There is not a comprehensive talk or a comprehensive subject that I have covered, but uncertainty is a part of life, as well as in the case of economy, as well as in markets. Both the approaches, fight it or flight, both the approaches have to be taken with caution. In most cases, the middle path is the better one. Take a mature decision, do your asset allocation, and do rebalancing once in a while. People often ask how often you have to do rebalancing. If you're doing asset allocation, how often you have to do rebalancing? I'll say 6 months is fine. And if something goes wrong in the economy and the markets, you can do rebalancing right away. Because the best opportunities only then you will be able to catch. So that is from my part. Do we have a Q&A? I think we have already ran out of time. If you have any questions openly or after the session, I am open to that. Thank you.
Thank you, sir, for sharing with us a very interesting session on uncertainties for investors. I'm sure it was an eye-opener for both amateurs and seasoned investors. We now move on to the second session of the event. I request Shri Francis George, Secretary of THRISSUR Management Association, to introduce the speaker, Shri ABHIN R. NAIK.
Good evening, everyone. My name is Francis George. I'm the Secretary of THRISSUR Management Association. It's a pleasure for me to be introducing the speaker, Mr. ABHIN R. NAIK. I had a brief interaction with him, not very brief. I had a good interaction with him at the chairman's office before the program. A fine gentleman and a very knowledgeable person who can add a lot of value to the audience, I think. He is the Assistant Vice President and Business Head of State Bank of India channel, specifically the State Bank of India Mutual Fund. He has worked with SBI Mutual Fund for 11 years now. Before this, he has worked with HDFC Bank as the Operations Manager. He has also worked with Religare Financial Services as Corporate Advisory Manager. Before that, he worked with ING Vysya Bank as Chief Relationship Manager. So a very rich experience in the financial sector. He completed his MBA in Finance and Marketing from Kongu Engineering College in Perunturai, Tamil Nadu. And he is currently pursuing his Certified Financial Planner course from the Financial Planning Services Board. That's Mr. Naik for you. Thank you.
Thank you, sir. I request Shri ABHIN Naik to please start his session. Thank you.
Good evening to you all. Thank you so much for giving this opportunity for me to interact with such an intellectual crowd. Since the time is really short, I think I need to make my presentation also very short and crisp also. So with this, I will start. I think half of my job has already been done by Jackson sir because he has covered extensively about the uncertainties and the risks involved and the bias. In fact, bias itself, I also echo the thought of Jackson sir that especially in this scenario where the market is so uncertain, we have to be cautious about the bias which is going to take over our mind in terms of investment. This anchoring bias, it's so particular in the current scenario, so we have to be very cautious. Today, I'm going to cover a topic in investing in mutual funds. It's a very large topic, but I hope I will do justice by making it very short and crisp. So what do you do with your money? You have three options. One is spend, second one is save, and the other one is invest. So it all depends which method you choose. Because two methods what you choose, but that is save and spend, you are not going to earn anything. As Jackson sir was rightly telling, if you say only save your money, inflation is going to eat your savings. And if you spend, ultimately what will happen? You don't have money to take care of yourself. Okay. So the crux is you need to invest. And when you need to invest is wisely and cautiously. Of course, sir has covered Mr. Peter Lynch. I will cover the investor himself. Do not save what is left, after spending, but spend what is left after saving. Okay, this is what we need to follow. In fact, I follow this in my life. I will tell you how it is. You're all youngsters. Maybe you can also follow if it feels good for you. I have 3 bank accounts. One is for my personal expenses, where I keep my ATM card. Okay, and once I get my salary in that, what I will do is for investments, I immediately change all my whatever I need for investments. I will automatically change to the next account on the same day, and I don't have an ATM card there, because if I have an ATM card, what I will do, I will go there and I will spend. Of course, now if you have online, definitely you can make you can take the transfer and you can do it. But still, I have kept a account for investment purpose, and second is for insurance purpose. So there, and also for my fees of kids, I keep it separate. So once I've done that, whatever is left out in my first account, that much only I will spend. So this particular word from the investor, the largest investor mouth, of course, not the largest investor, as Jackson sir rightly said, one of the largest investor, Mr. Warren Buffett. Now, as I said, inflation is going to, if you go for savings alone, inflation is going to eat your savings. Let's see how it is. Now, today, if you are having an expense, monthly expense of 30,000 rupees, normal or family ki vendor 25 to 30,000 rupees. Okay, I just taken a 5% inflation. What is the inflation right now? As CPI sir was asking. It is much more than that. Allah sir. If you personally ask me, it is double digit now. CPI another real inflation, it is double digit. But I have taken only 5% of inflation. So after 20 years, what you need to spend? If you want to maintain same living, it is 80,000 rupees. So be prepared for that. So you need to invest in such a way that it will beat your inflation also. Second school of thought given by Warren Buffett, never depend on one single income. Okay, you need to, as sir rightly said, even for business, never depend on your business income alone. For business people also, start investing, find a source of second income. It's very, very important and very valid also. Okay. But when you invest, always keep a financial goal in your mind and keep revising that goal. In fact, that is what we pursue in even CFP. We will be having a financial goal set for a certain period. But are we meeting that? Is my financial investment, what I've done right now, is going to meet that? Am I going to meet that goal? That is very, very important. For that, we need to spend some time. We have various avenues, as sir was telling. We have various avenues. Property is there, or real estate is there, insurance is there, bank deposit is there, gold is there, stocks are there, bonds are there. I'm going to talk about a valid asset class called mutual funds. Now, this I have covered already. Jackson sir also covered the importance of asset allocation. I was about to stress more on this, but I think I will just brush up on this. Asset allocation is just like a thali. Have you seen Gujarati thali? Typical Indian, South Indian thali will be like, there will be avial, but you know what Gujarati thali they have? They will have a lot of curries involved, chapati is there, papad is there, everything, jalebi, everything is there. So your investment also should be like that. But that doesn't mean too much diversification will also not going to help. Am I right, Jackson sir? Too much diversification itself will spoil your investments. So cautiously you do in such a way that your financial goals are met. That is more important. Now, I don't need to cover you what is mutual funds and all. You will be knowing better than me. I just give you an evaluation of, or the evolution of mutual funds. It all started with 1963 by UTI, and where we are standing in a moment where the as total assets under management is almost 14% of GDP. Okay, 10 years back, where were we? And now, right now, where are we? Mutual fund is catching up like anything. I think the industry is growing at around 17 to 18%. Deposit size is also growing at around 15%. My company, SBI Mutual Fund, if I can name, we are growing much ahead than the industry. In fact, we are growing at a rate of 40%, better than the industry itself. I'll just give you an industry background. Total assets under management is around 38.56 lakh crores asset management, total assets, okay, which is 14% of the GDP. And in fact, last 10 years, it has grown 5.5 times, 500 times folds it has grown. So that shows the importance of the industry now. And the total folios also, the number of customers is 12.61 crores. So it is growing in such a big way that you cannot just avoid mutual funds from your portfolio. So this is one just background. Last 1 year, sir. Last 1 year net sale in equity alone I have taken. This shows how people are serious about mutual funds. Last 1 year, the industry equity sales is almost 2.3 lakh crore, in which the top 5 private sector banks has contributed 18,362 crores, whereas State Bank alone has done 26,000 crore, which is 11% of the total industry. So this shows the financial inclusion, what is happening in India right now. So this also shows how mutual fund is important and how it is, why it is important, and why you should not avoid mutual funds into your portfolio. Of course, the merits of mutual funds, it is professionally managed. You have a very good fund managers, and as Sir was covering on uncertainties, and if you want to manage these uncertainties, and if you don't have the practical expertise, then you can rely on asset management companies. Mutual funds are really transparent. You know where your money is held up. Liquidity part, it is as simple as that. Within 2 working days or within 4 working days, whatever amount you have invested, you will get it back also. And now technology is also so improved that with your tip of finger, you can take your money anytime you want. Then highly regulated. I don't know, SEBI sir is there. SEBI's they catch hold of asset management in such a way that we cannot in fact do anything against the investor. I'll just give you a classical example. If we are coming with an NFO or a new fund offer, you know how much the company need to invest in that NFO, or you know whether the company need to invest in that NFO. An asset management company has to invest its money into NFO. You know how much it is? It is 50 lakhs. And you cannot take that money until and otherwise the last customer in that particular scheme withdraws the money. So that is a kind of restriction what the SEBI has brought out in, or rather regulating the asset management company. I prayed IRDA would have been the same. We were discussing few things before coming to this particular session, but SEBI is well regulating macro. They are doing it really well. In fact, micro, we don't know, but macro level, they are very strong in managing. It is convenient. You know, even for a chaprasi, if he want to invest 100 rupees in mutual funds, he can do. We have various schemes where even a customer can invest even rupees 100. And low cost. The cost involved in mutual fund is much less compared to any other asset class. I'm not covering in detail what is mutual funds. Of course, the types of schemes. We have majorly debt and equity schemes. But generally, there is a myth that mutual fund invest only in shares, but it is not so. And also, mutual fund can be invested only if you have huge money, or I have to be long term. No, nothing like that. We have various types of schemes. In fact, in equity schemes, of course, you need to have a very longer period of time. As Jackson sir rightly pointed out, you need to be staying slightly longer in the current scenario, because the market is going to be very uncertain. I echo what sir was telling. It is going to be very, very uncertain until and otherwise the economy settles down. Short profit making is not possible even in any asset class, especially in mutual funds. But if you want to invest for one day, is there any product? Are you aware of any product in mutual funds? Anyone? No. You can even invest for one day. For business people also. You are advising a lot of business people. We have a product called overnight fund. Have you heard about it? There is a product called overnight fund which invests only for one day, where the underlying paper will mature in one day. Of course, the returns will be in that particular scheme will be much smaller. But what you need to compare is when a businessman invests in current account, what he will get. Yes? Current account letter interest. Yes? Nothing. Practically nothing. So if we can keep that money for say 10 days, we have Onam holidays, right? We have Onam holidays, Christmas holidays. For 1,000 rupees, you can get around, 1 crore rupees, you can get around 1,500 rupees for one day. So just imagine if you can keep it for 5 days, how much you earned? 6,000 rupees. Can't you pay the salary of a person or a watchman who is standing outside, or pay an electricity bill? So this is the way the mutual funds has changed. In fact, we have a lot of customers who are investing in this particular scheme, overnight funds and liquid funds. And even for you, practically an advice from my side, at least 6 months salary. If you're a salaried person, 6 months salary, please keep it as a buffer in your liquid fund. Please keep it as it is. Tell me, what is your interest, what you get in your SB account? How much? Have you seen all these things? No. Okay. It is hardly 2.75%. Okay. But if you invest in liquid funds, you will get around 3.5 to 4%. So don't you think it is better? And liquid funds, what happens is, if you give a redemption today, very next day, you will get the credit. But there are some liquid schemes where up to maximum 50,000, you will get the credit on the same day. So liquidity is also there. So there are a lot of mutual fund schemes which is available for even youngsters as well as business people for a shorter period also. So debt schemes is equally important, as sir rightly said. Debt schemes are very, very important. I told about overnight fund, liquid fund. Then you can also invest in for a longer duration, like ultra short term, low duration money market funds. Generally, these are all debt scheme where there is no equity exposure at all. But the kind of return what you can expect cannot be compared with an equity scheme. Generally, what I've seen is, once you start getting returns, they will start comparing with the highest return what you get. Most of my customers say, Abhin, I invested in debt scheme, but it has given me only 7%. But you should expect only 7% from a debt scheme. How can you expect 12 or 15% from a debt scheme? It can give you one fine morning if interest rates are coming down. But do you think the interest rate is going to come down in the near future? Inflation is going up. So I don't think, maybe I will give a school of thought whether, but debt scheme, definitely as a buffer, you can keep it as an allocation. I'm not covering much because the time is also limited. I need to keep it very, very short. But this point I will cover. Hybrid schemes is very, very valid at this point of time, which is a combination of both debt and equity. At the current scenario, from a responsible asset management company, we are focusing on hybrid funds, and we need to be called as hybrid fund house also. So my request to everyone is, whenever you are advising your clients, or when your client are asking your opinion, please tell them for the next 3 to 5 years, stick to the hybrid funds. Even in hybrid funds, we have various varieties like conservative, balanced, aggressive. All these things are there. depending upon their risk-taking ability, they should invest. So risk-taking ability is very, very important. This one I will cover. Apart from hybrid, sir also rightly pointed on that, index fund. Okay, very passively managed fund. The cost is also very, very less. The current scenario, two funds which I suggest is one is index fund and the other one is arbitrage fund for a very shorter period. If you have NRI clients and all, if they are seeking your advice, please ask them to go for arbitrage fund, because the advantage what they get is the taxation part on the arbitrage fund is on equity side. Okay, whereas the safety, from the safety angle also, arbitrage is much better than a common equity fund. But the kind of return what you expect from an arbitrage fund should not be compared to directly to the equity schemes. But you will get a handsome return better than what you get from a debt funds itself. I meant short term, not long term. Sir was telling about gold also. I thought I will cover that, but since sir has covered, I will just skip it. But I also feel that apart from ETF, I think gold scheme from the government, gold bond from the government has a better edge over even over ETFs. Hello, sir. It is in the taxation angle also, as well as the return angle also. I think, but in terms of convenience and liquidity, I think ETFs are better, because liquidity part, I don't think gold bond schemes, it is 8 years. But the liquidity part for ETFs are much lesser. So if you want a liquidity also, of course, and the cost reduction, if you want to make, ETFs are much better. International funds are there, but now it is restricted because of the technical angle. But otherwise, international funds are also there. This I've already covered. I just want to cover one more point in terms of uncertainty which is prevailing. You are all youngsters. I'm going to tell a story about myself. I, as an youngster, started my investment in 2011 with bits and pieces. And you won't believe, if I take my portfolio right now, I can close almost 80% of my home loan. Now tell me, should I close my home loan? You're all chartered accountants and CMAs. Tell me, is it wise to close my home loan? Yes? No. Why? Yeah? Correct. The kind of return what I get on my investment is almost 17% if I take my CAGR right now, whereas my home loan is running at around 6.75. That is one point. Second, in taxation angle, as a chartered accountant, what you will advise? You will get tax benefit, correct? You can maintain that. And what is the tax advantage in mutual funds? You need to pay capital gain of only 10%, correct? Over and above exceeding 1 lakh in a financial year. Whether the government is going to change it or not, we don't know, because this government is unpredictable. So till now, they have not changed it. SIP is one method of investment which we recommend all our customers. How many of you have SIP? Only 2 in this crowd. I think, sir, you have a lot of customers around you. I think you should go for this SIP. I told no, I started my investment just by paying 2,000 rupees. Gradually, I increased it. Right now, my home loan is 54 lakhs. I can close 80% of my home loan. And I have not invested in big amount. I just started with a 2,000, 2,500 rupees SIP. And gradually, I started increasing it. Now, there are various methods in mutual funds by which there are top-up facilities. In fact, I should urge everyone as a youngsters, you should go for top-up facilities in SIPs. Okay. Now, I will tell you the reverse of this, which I need to cover also. I will just cover an Excel. Can you see this Excel there? Is it visible? Yeah. So I'm just going to cover the straight reverse of SIP. Now, suppose you started an SIP and you have a corpus. I'm going to give you an example. Here, I'm not going to market any of my product. I just put an illustration. A customer has invested 1 crore of rupees in one fund in 2010. And he started withdrawing 60,000, which is 0.6% of his whatever he has invested. Okay. This 60,000 can be used as what? As a pension for him, or if his parent is living in India and he need to send a living cost, or if he has a home loan or any loan which he need to be paid. Okay, this customer investor, this is ende thanne oru real customer aanu keto. He is a real pullide illustration aanu njan idu eduthirikkunnathu. He is continuing it. Okay, till now 2010 mole iduvare what he has withdrawn is 88, almost 86% of his investment. How much he has withdrawn? You can see there in red. 85,80,000 he has already withdrawn. Okay. What is his current value? It is 2 crore after withdrawal of almost 85 lakhs. And what is the tax he has paid till now? You can see at the bottom, it is hardly 2,65,000. Had he made the same investment in some pension plans or anything, hello sir, he would have paid how much tax? If he is in 20-30% bracket, how much he has paid as tax? Almost 21 lakhs he would have paid as tax, whereas he has paid only 2 lakhs. So these are all the methods which is there in mutual funds which you can adopt, which you can even tell your customers also to adopt. This method of investment is called systematic withdrawal plan. So what I'm intent to do in my personal life is also the same thing. I'm building a portfolio which will create a corpus in the next 5 to 10 years for me to manage my expenses. And after that, I'm going to go for a systematic withdrawal plan or SWP, which will take care of my expenses. So there are various methods in mutual funds also which you can adopt. I thought, okay, I will just brush upon those things. And with that, I will stop here because the time is so limited. Now, if you have any doubts, you can just cover upon, or otherwise I'm done.
Thank you, sir, for engaging us with a very precise and crisp presentation. I now request Mr. Vinod Manila to speak a few words.
Good evening, friends. Chairman of ICAI THRISSUR chapter, my friend Ajit. The chairman of ICSI, Mr. Sugesh, CS Sugesh. My friends from TMA, my honor secretary, Engineer Francis George, CA members, and dear students. I think we had a fantastic session. In fact, I'm coming to this campus for the first time. So in fact, you have one of the best campuses I've ever seen in THRISSUR. So congratulations to this institute for that. TMA and the CA Institute has a great relationship. 4 of our past presidents are CA members, and many more in the pipeline. I can see already Manoj, the executive committee, and many more coming from CA Institute to head TMA. So one of my intention of coming here was to impress upon the student, but unfortunately they have already left. Anyway, so we had great speakers this evening, so I don't want to dwell on much into it. As a businessman, unknown is always a little worry. We need to build trust. So we end up investing in maybe gold, land. Beyond that is the cause of concern. So whenever I had the opportunity to listen to a seminar like this, I get really motivated. The FOMO comes in, fear of missing out. Then I go back. Then when I hear a story like Paytm, then I said, no, I think I should wait. So that has always been the story with mine. However, I went on reading about some of good investor, one of them that I've kept a close watch was Bridgewater Associates, Mr. Ray Dalio. And his book, I think you should read, is called The Principles, and is a fantastic book. So some of this theory I use in my business. One is the blind spot barrier theory and the ego to be right always. In fact, he talks about an algorithm where the heads of the organization should use the blind spot theory, which helps you to make a better decision. And I think in the case of an unknown territory like hedge funding, that is widely required. And if the concepts of that can be used in a business, it will help you to grow. This is one takeaway I had. So with this, I would like to close my speech. I congratulate Ajit and team for organizing a program like this. 4 organizations are involved. In TME, we have had only programs with 2. I think this is a new format that is going to go in the future. I think all the associations will come together for the benefit of the society. So thank you for inviting us. Thank you. Bye.
Thank you, sir. I now request CS Sugesh Ram to present a memento to our faculties of the sessions. Firstly, he will be presenting a memento to CS Jackson David. Next, he shall be presenting a memento to our next speaker, Mr. ABHIN NAIK. I now request Mr. Vinod Manila to present a memento to ABHIN NAIK. And lastly, I request CA Ajit Kaimal to present a memento to CS Jackson David. Thank you. I now request CS Sugesh Ram to please propose the vote of thanks.
So good evening to all. So we had a session on investor awareness, basically who is an investor and what should be the basic lessons for an investor. So our own fraternity member Jackson sir was speaking about basics of investment. Then ABHIN sir was speaking about merits and demerits of, not demerits, merits of mutual funds. So I think the audience got an idea about what is an investment, what should be the basic lessons for an investor. But as Albert Einstein said, greed, fear, then what you call stupidity. But I think more than that, I'm not an Albert Einstein and I don't want to get into that area, but more than that, investor is a person who always embraces himself for volatility, uncertainty, then complexity, then lot of ambiguities. He always faces VUCA situation, if I'm not wrong, especially in the context of like lot many mystic yogis, Himalayan yogis, platforms like NSE. So I don't know how an investor on the street is going to face such situations. Okay, really then the situations, what would be the position of an investor? I don't know. Anyway, but more than that, more than the fear and all, I think former factor is the most important element, I think, because that's why even if we are losing in Paytm, we are waiting for LIC IPO. So we will catch up there. Okay, now coming to the formal part, my duty as an ICSI chairman is to express vote of thanks on behalf of 3 August institutions. That is ICAI THRISSUR chapter, ICAI CMA THRISSUR chapter, then my own ICSI THRISSUR chapter. So on behalf of all the 3 chapters, I express my vote of thanks to Mr. ARUN EA, AGM SEBI. He took time to address all from Mumbai, and as a chief guest, he addressed the audience. So I express my gratitude, thanks, everything to Mr. ARUN EA for joining us from Mumbai. Next is CS Jackson David, Head of Navy on Wealth, our CS former chairman. Again, on behalf of all the three chapters, I express my vote of thanks to Jackson David for joining us and guiding us on the basics of investment through some shift, very energetic quotes, funny quotes. Anyway, ultimately leading us to invest where and not to invest where. Then next one is ABHIN Naik sir, again from SBI. So when I was listening to his speech, I was thinking about or inviting him for CS chapter programs also. I think he'll be agreeing, and I think he's based on THRISSUR only, you know. You are from Trivandrum, but based on his convenient time, our chapter officials are here only. So in future, CS chapter also will be inviting him to THRISSUR so that we can have more sessions on investment, and also that even CS members get enlightened from his words. So again, on behalf of this audience, I express my vote of thanks to him. Then coming to Vinod Manjula sir, he is known figure to me for a long time. Now he is President TMA. Thanks to Vinod sir for joining us. So again, on behalf of this audience, I express my vote of thanks for joining our joining and sharing few words with us. Then CMA Praveen Kumar, our own fraternity member, our own brother, chairman of ICAI CMA chapter. He was about to join from abroad. He's out of session, but due to some technical issues, he couldn't join. But anyway, thanks Praveen for being part of us, for organizing this program. Then finally, students, other members, chapter officials, and all other members, staff who worked and took efforts to make this program happening and making it a successful one. So finally, thanks to all. May God bless all of us. Thank you.